Up, up, and away seems the market's theme here this week. We continue with another post-jobs report move higher to another new all-time highs for all the major indexes this time. So I'm going to break down now the relevance of this big extended move, maybe why we got it this week, why it all seemed to come in this week, and why it may not be as surprising as it seems. So I'm going to break down some technical patterns there. I'm also going to break down again how to recover, how to protect against some of the gains, especially in some of these bullish positions we've entered in recently that have had some decent gains. How can we protect but still remain strongly bullish according to the posture and the trend? So let's go ahead and get started. Today is Friday, January the 5th, 2018. This is the Market Outlook video from MarketScholars.com. My name is David Settle. Thank you very much for watching today. Remember, you can find us up here at MarketScholars.com. There's my email address as well, david@MarketScholars.com. Welcome to those that are watching for the first time. Subscribe to my YouTube channel by clicking that red subscribe button right down there below the video. You can do that right now while we're speaking. Also, while you're down there, hit that thumbs up icon. That lets me know that you liked it today, that you want me to do it again. It's a really easy one-click way to give me feedback. Scroll down further and comment on anything that stood out to you from today's video. Appreciate all the comments we got on last night's video. Keep them coming. I'd love to see what you're learning. And if you have any questions, I'm able to respond to those there. In the video description, there's links to subscribe to my daily email Market Outlook newsletter. So make sure you subscribe to that so you can get emailed time-stamped hyperlink summaries of each segment that we go over here in these Market Outlook videos. You can follow me on Twitter for more content. In addition to these videos, you see my handle on the screen up there at the top, at DavidSettle42. Pinned to the top of my timeline is tonight's Market Outlook tweet. Like and retweet that. The more you like and retweet my content, the more Twitter will keep pushing it out to you. Same thing. Join the Market Outlook community on Facebook. There you'll see I'll post stuff in the community as well as other community members. Make sure you keep on engaging, liking, sharing, commenting to make sure Facebook, which is worse, keeps promoting and pushing you the content from my feeds. All right, as always, we'll start off taking a look at the S&P 500 with the market forecast indicator. So there's our 4-day rally, and again, you know, to have a combination to start the year with all-time highs each day, because this was an all-time high and then every day since, and then the total number of gain, the total combined gain with 4 new all-time highs to start a year, that's the biggest move that we've seen. Continued. That was the case yesterday. It was actually the case on Wednesday, and every successive day as we continue to drive higher here. Again, coming off of a near-term low point here at 26.75. One thing to keep in mind. So again, this is the Christmas holiday right here, and then you had right around in here. So it's like what between these two candles, the Christmas holiday, and then you also have this kind of year-end selling phenomenon. That was kind of a crazy day in and of itself. A lot of that loss came in the last half hour of trading, so big decline in the half hour. But if you take away the holiday and then that crazy decline, and you say, okay, well, go from here, because see the market just kind of was messing around heading into the Christmas there. If you just kind of go from point A to point B here, you know, that's a 2% move. You know, annualized 48.5% gain. You know, that's a pretty decent move. But if you look at it from this way, that's a 283% annualized gain. So what ended up happening is, you know, we've had a move higher from 12.18 to now, but because of the holiday kind of suppressed activity, and because of the new year, kind of regaining that. So I think a lot of this week's move is due to the fact that we didn't get much of a move around the holidays and because of that drop that we had. I mean, look, if you take away that drop, then now Monday's move or Tuesday's move doesn't look so big. But of course, the last few days. But again, you know, how much of this gain, this rally, came because of the calendar switching over, and because we were compressed a little bit on Christmas, again with a lack of trading and lack of volume and not really much movement. So, but regardless, if you take a look at this move from from Friday on here. This is the post I tweeted out today. So that Friday we closed at 266.88. Again, 2 points off of the high. So the high was closer to 267, or 269, excuse me. So that we opened kind of in this area here. But because of that late drop pushed us all the way down below 267. Now to get to 273.42 and close there this week, based on volatility levels back on that last Friday, it's a 5% chance that we would have done that. Not quite 2% or 2 standard deviations. 2 standard deviations would make that percentage 2.5%. So not quite 2 standard, but still pretty decent. I mean, 1 standard deviation would leave that number at 15%. Roughly. So obviously we're a lot closer to 2.5 than we are 15. So we're a lot closer to 2 standard deviations than we are to 1. In fact, the shaded area is 2 standard deviations. There's 1 standard deviation move. Just getting up to 271 would have been a 1 standard deviation move. So you can see how, you can kind of gauge how big a move this has been this week. I also wanted to point out here a comment on YouTube. Here we go. So this comment, I pinned it actually to the top because I wanted to bring it up. And I hope that this isn't the case. I hope that not everybody missed this move. I mean, yes, it was bigger than expected, than I expected. It was a decent move to the upside, again, especially considering the near-term volatility. And I'm still expecting near-term volatility, which means, again, ups and downs. So, while the amount of move we've had was unexpected, it still is a strong bullish posture. And a lot of the trade ideas we've been talking about have been bullish lately, like Netflix, like Halliburton that we did at the beginning of December. We've been doing a lot of, there's Netflix that we did right before the end of the year. That was our trade idea. Even the one, now granted, we did do a trade idea on a bearish one on EA, which with the breakout above 110 today would signal to take a small, take the loss on that one, take a small loss instead of waiting for it to get above 115. But we also looked at a bearish trade on Apple, but it was a back ratio, so it kept our risk from the upside, because that's what we were worried about. Kept our risk from the upside minimized to the actual credit. So there was no risk of loss to the upside on that ratio spread. It was a risk if we went significantly down to the downside. So if you notice, a lot of the things we've been talking about have been bullish trades, and I want to make sure that that when you're looking at these trades here, and when you have a posture, our posture is strongly bullish. I have been outlining a lot of the risk factors are out there, but that doesn't mean that we're not bullish, because the posture is still bullish. It just means that we manage risk and we don't take on as big a position size. Now, does that mean with a smaller position size we're going to miss out on some things? Had we had a normal position size? Yes. But again, 4 days, go back to SPY, 4 days doesn't mean that all of a sudden now we're going to move like this forever. Again, that's a 238% annualized return. We're not going to move like this forever, and we're going to have downturns on this. But despite all of that, we are still bullish. So any new positions we enter should match that. And yes, we can have some balance, and that's why we took the EA trade. It wasn't because we were strongly bearish. It was to add some balance to an active trading portfolio, and it was an example of how to do that. Yeah, there are a lot of risk factors out there. We can still enter new bullish trades. They should just be small. And we should enter some bearish trades, but not because we're strongly bearish. More because just to add some balance, reducing the long delta exposure our active portfolio may have, just in case things start to pull back. But still are able to make us some money if we keep going up like we did this week. So I appreciate the comment and appreciate the opportunity to have that kind of discussion. So yeah, I might sound like I'm bearish because there are a lot of risk factors out there that I'm pointing out. But those risk factors do not tell you to go against the trend. It tells you to manage risk appropriately. And that's a comment I made on another Facebook. Is success in trading comes not necessarily in timing. It comes from how you manage risk, because it's all probabilities. Even your directional trades end up being probabilities. All right, I'll get off my soapbox there. Now let's take a quick look at the other major indexes and how they're doing. You can see the Dow Jones, and that was something I also tweeted out here earlier today. The Dow Jones Industrial Average is trading above its 1-year linear regression line. 2 standard deviations above its 1 year linear regression trend line. So there's the best fit trend line. That's on the 1 year basis. Here's the 5 year. I've zoomed in on all of them, so it looks the same, but it's just a 5 year chart, which means a linear regression. You can see it's a little bit lower here, or that's how far up we are based on that move here from the end of August. And then finally, this is the 10-year linear regression. So even more significant because of the length of the time frame. And you can see now where that linear regression line is and how far up above it we are. So, Bitcoin might be exploding, but it's not the only thing. The Dow Jones is also trading. It's one thing for it to trade at, say, like above a 3-month or 1 month. The longer the time frame, the more significant these technical signals are. They don't change overnight. The longer time frame also means the signals don't work out. They take more time to work themselves out. They're more reliable, but they take more time. So that's why we don't get as many on the longer time frames. Shorter time frames, you get a lot more signals. They work out a lot faster, but you also get a lot of false signals too. And so that's the give and take when you're looking at technical analysis. But I wanted to point out, the Dow has really been, had quite the move. Obviously all-time highs too. You can see the near-term lines up in that reversal zone. Taking a look at the NASDAQ composite here, you can also see very similar to strong bullish posture, strong short-term sentiment, and finally the Russell 2000. You can see the Russell 2000 finally closed a smidgen above that high at 1559.61, not even a half a point did we get above that. So not technically a breakout there, but you can see a similar pattern on the market forecast. So strong bullish postures, strong short-term sentiment. Again, because of the length of the intermediate run, expecting near-term volatility, which doesn't mean that we're going to drop in the near term. It just means that there will be more near-term highs, more near-term lows. And we've got a quick short-term, near-term bounce here on the 4-day window. Now, expect at some point in time we'll get a near-term drop. Doesn't have to be the lower lows, doesn't have to be the equal lows. But when your intermediate trend has gone on this long, you're going to get more ups and downs. You're going to get more ovals, green and red ovals here on the index because, again, the length of that intermediate trend. And again, we saw this before, so this isn't unprecedented. If you go back to the end of last year after the election here, just zoom in on that time frame all the way to March, so you can see it's not unprecedented. We came off here, the intermediate posture crossed above 50. We're 1, 2, going on 3 months with a lot of ovals, a lot of near-term highs and lows because that intermediate line was 3 months in, and then boom, we had a late move, just like we're getting right now. Now, whether or not it's that long, because this is the 4th month, and we've already had our 4th month. On this intermediate run, but you can see how it made that big move, and then of course more volatility came after that. So it wouldn't have been that volatile had that move stopped right around here. Then we just would have found a way to grind higher. But again, we're getting a similar kind of move now that we're getting here, where we're coming out of a bunch of ovals without an orange oval, without an intermediate low point, and we're starting, we're pushing up to a new high with some pretty decent volume too. You can see the long-term chart and look at that rally that we had here. That's a big candle at the end when momentum is this high. You can see we typically don't get big candles when momentum is this high, especially when we're we're already that far up above the 50-day moving average. Usually we get them around the 50-day moving average, say after a test. We were already pretty far above the 50-day moving average. And again, I can just highlight just how far up above we are here. We'll change it to current price, change it to the 50-day moving average first. Again, the highest on an absolute basis of the last 5 years. Very, very strong move to the upside. How far above the 40-day, 200-day moving average, the 40-week, and there you go there. Just again, how far up above these long-term moving averages we are. Take a look at the 3 green arrows. You can see we got 3 green arrows. That MACD is just taken off. The MACD is up to 20 points above. Again, similar to end of February, beginning of March, in terms of on an absolute basis, how far up above we are. And again, if I were to change that MACD down there, instead of looking at the gap between the 8 and the 17-day moving averages, if I look at it compared to the first of all to the 8-day moving average, there we go. You can again see how far up above we are, significantly. The biggest peak we've had in the last 52 weeks. Can change that to how far up above the 6-week moving average, that 30-day. Here, give it a second to load up. There we go. 75 points again, higher than what on an absolute basis. Now not on the relative, but on an absolute basis, higher than we got on that March kind of blowout move. So, needless to say, this has been a crazy week. It's been a strong bullish week. We've had a strong bullish posture. It's been maturing. We kind of broke out of some near-term volatility here. And the last time we did that, it went for about a month. Again, that would be 4 months. This would be 5 months if we got a similar move. But we got this far up above, and that's when we ran out of buyers before. Now, it didn't change the trend. The pullback didn't change the trend. We've talked about the trend pullback that might be in this 23% Fibonacci area around the 2-week range. So this is the kind of thing we can expect to see once we run out of buyers again. And just kind of a side note, there's been a lot of talk of euphoria as people liking this market move and not liking it back here. There's been a hated bull market, and that's a concern. So again, markets, when it seems like markets will never go down, that's the time not to sell everything. It's not the time to go bearish. But it is a time to reduce risk. Risk being on your long positions, risk being all those profits that you've generated getting to this point and starting to take some off, reducing position sizes. Moving up stops can be dangerous, but because you can get stopped out on a whim. So you want to keep those below support. But you can reduce your portfolio risk by taking some shares off, taking some contracts off, reducing your position sizes because of how bullish we are on those long positions, and adding some balance, some bearish balance to your portfolio. All right, so when you look at the intraday chart, see there's that move I'm talking about, how we dropped 2 points from the open at 268.5 all the way to almost to 266.5. We did actually hit below 266 or close to it on a intraday basis before closing at 266.88. So big move on Friday, which ended up being last week's range because we were so small, and you can see how Christmas really compressed the activity there, and that's why we didn't it would have been, if we would have kind of continually gradually moved higher throughout the holiday, then you can see it wouldn't be that big of a deal. This move isn't so steep, but this move is steep because of two things. Christmas kept things really flat and very tight, low volume. The end of the year was a big move to the downside, obviously for no reason. We never did break any kind of major support. And then so now to recover that, got us to that point. We recovered Friday's loss. And then of course, Wednesday, kind of starting to push things higher because we didn't get any movement here. So, again, you draw a gradual line up this way and you can see again, not that significant of a move. Only significant because lack of movement here and the big kind of out of the blue drop, especially in that last half hour here. There's that last half hour that I'm talking about. But today, another strong move higher, another day of a lot of volume. Look at all that volume coming in at the beginning of the year. Not typical bullish volume when it's that strong, unless you need to break through a resistance, which we're not. So big ranges, which again, 1 2/3 points. Today we gapped up again, so we started at 271.61. The low was at 271.95, so about a third of a point gap that we add on to the range. So it's about a 2-point range with 80 some odd million shares trading. You put that in context, volumes up here and trading ranges up here, and again, those aren't bullish moves. When we're riding a bullish move higher, we want it to grind. We want it to be small moves. We want to bring these lines down when we're grinding higher, and we're not. It's hard to bring these lines down when the volume's still up in the upper half of its 52-week average range, and the trading range is also is above its highest average trading range over the last 52 weeks. So again, you can see this is near-term volatility. It's like, what do they say? If it's really, really cold, it kind of shows, that there's, no global, it's a common thing for people to say it's no global warming because it's so dang cold. I'm sure a lot of you are thinking that in the Northeast and in those areas. Not so much here in Utah. We're having, it's almost a really, really dry and bad winter here. But you get the idea, that the idea is that temperatures and weather is a little bit more extreme than it has been, from a warming standpoint and a cold and stormy weather standpoint. Same thing. You get the end of an intermediate trend, you're going to get more near-term volatility. And some of those near volatile moves will be to the upside in the direction of the trend. But any kind of move like this will be accompanied at some point by a similar move to the downside. And you can see how the volatility has been picking up on every bullish move previously. We had some volatility after. We'd expect the same thing here, and unless it was slow and steady, which it has not been. You take a look at the volatility index, continuing, it's actually kind of gone up the last couple of days, despite the two big moves. It's unable to get and stay below 9, and in fact, on an absolute on a relative basis here, you can see it's still at, it got above 75%, but it's still at extreme lows, well easily below the 80% mark. So volatility is still setting up for a move higher, and of course, a move higher would coincide with a move lowered, and I mean that would not be earth-shattering. And it's not like I'm a perma-bear. It just means that you have ups and you have downs, and we've really moved up this past 4 trading sessions to the point where it was a low probability move, not an impossible move, but a low probability move. And so what does that mean? It doesn't mean load up on bearish trades. It doesn't mean to close out all your bullish trades. It does mean take some profit on what's really worked. That Netflix trade we talked about before Christmas is like up almost 10% since then. So take off moves on things that work, take off profits, reduce your positions, and go with really small trades. If you're going to continue to trade bullish from today going forward, smaller than what you normally do, and add some balance, add some bearish trades to reduce delta exposure, but not too much, right? Because the trend is strongly bullish. But it's okay to add some balance, some bearish trades for the purpose of balance. Even those trades would be positioned smaller than obviously what you would normally do if you were in a bearish trend. All right, so as we talk about what's driving this action today, quick reminder, remember to hit this thumbs up right here. That lets me know that you like the video, and you can see the ratio that a good ratio for YouTube channels or YouTube videos is about 10, actually less than 10%. More like 4 or 5%, and you can see that's not the case here. So I really appreciate all of you that are letting me know that you want me to keep on doing these videos. Because that's how you let me know. It's a really quick and easy, just one click while you're watching. Also, we got a lot of comments, so I really appreciate the comments. Remember to add a comment on anything that stands out to you from the video. I love to hear what you're picking up, what you're learning, things that maybe you didn't hear before, things that you're reminded of that you haven't thought about for a while. All right, and also remember to subscribe to the channel. There'll be a red subscribe button there if you haven't already. All right, that being said, we'll take a look at the asset classes, and you can see, the biggest movers have been commodities and emerging markets. The crude oil gave back some of its gains here today. You can see the biggest movers today were international stocks, the S&P 500. Gold is down a little bit because the dollar was up a little bit. It's been down. People giving back their gains in gold and in crude oil. Don't read a whole lot into that in terms of new bearish trends. Just pullbacks as commodities, and that's something too I tweeted out. Couldn't quite get that one on Facebook. But commodities is in a low point of its cycle relative to S&P 500, and then of course emerging markets and the outperformance in international stocks have been something we've been talking about all 2017 practically, and that's been the case so far this week, and will most likely be the case for a long time, because there's so much opportunity for outperformance in these international areas relative to the S&P. That doesn't mean that the S&P is going to go down, obviously, because the S&P 500 went up this week. If I were just to zoom in just on the week that was, obviously the S&P 500 rallied up almost 2.5% this week. but international stocks really whooped it. And crude oil, in fact, almost matched that return. And the S&P really outpacing the riskier small cap index. So you can see how it hasn't been that crazy of a move, especially in terms of risk appetite, because large cap stocks have been dominating. You can see high yield outpacing treasuries. You can also see crude oil outpacing gold. So there is some in emerging markets outpacing developed. Those are some risk on attributes, but not completely from a U.S. standpoint because of the outperformance of the S&P 500. Of course, the big news on the calendar today was the employment situation. The jobs number came in at 148, which is a little surprising to the downside considering the strong number we had on ADP. Unemployment rate staying the same. You can see average hourly earnings rising at 2.5% on a year-over-year basis, rising on a monthly basis there. The participation rate flat. So not a whole lot of even the hours work week here flat too. So not a whole lot of movement. Of course, we like to take a look at the year-over-year change in jobs, which had been jumping up the last couple jobs reports. Again, we've seen this before. It's on a gradual decline, and don't be surprised if we continue to gradually decline with a really, really, really low unemployment rate. So the economic surprise index hasn't been updated here on this chart yet, but still very, very high. The odds of a rate hike in March continue to be above 70%, and you can see the odds of 2 rate hikes by June continue to be higher than just 1. That's the gray line. And then, of course, by the time we get to September, which would be the 3rd rate hike, this 200 to 225 mark here, you can see that how now that's higher than just having the 1 by September. And you can see, of course, December would be this 225, 250 by next December. That's the orange line here. On this one, we'll click on there. There we go. And you can see that's this line here, this dark blue line, and it's rising. So the market's starting, it's not very high, but it's rising. So the market's starting to put in odds of a rate hike every quarter next year. Those are the meetings where there's press conferences. That's how they've done it in the past. And the economy continues to chug along even though the GDP estimate dropped, still pretty decent economy to support rate hikes, at least according to what the futures market is saying. So a bad week with yields up this week and bond prices down is a bad week for utilities and real estate. Those are really the only losers. Staples is flat this week. So not a good performance for Staples either. Financials had a good day yesterday, couldn't hold those gains, and lagged behind as well. But you can see how materials, energy, technology, consumer discretionary all doing very well this week. Just looking at today as pretty much a technology move day, as energy stocks gave back some of their gains. They've been performing so well. There's your interest rate sensitive areas, small gains, but still lagging the market along with financials. And of course, materials, technology, and discretionary continuing to lead. And those are your bullish sector areas, and they are leading the market higher, and that's a positive for the trend. Doesn't mean that we won't get a short-term pullback. It's just a positive for the market when those areas lead it higher. When you start to get concerned is when you get up moves, maybe not as big, but up moves in the broad market, and staples and utilities are leading the way higher. That's when you know, okay, we're a lot closer to an intermediate pullback than we're getting a lot closer to an intermediate pullback. So not a near-term pullback, but an intermediate, a little bit more longer time frame, an intermediate pullback. So now the question is, okay, what can I do to protect and hedge a little bit of my position? We don't want to be aggressive with hedges. They're expensive. And the market's strongly bullish, and it can stay irrational for who knows how long. And we don't want to trade what we think the market should do, but we want to be prepared based on our expectations. The trend's strongly bullish. We do expect some kind of pullback. We do know that we have this wide 4-week range that we're in. And we don't typically get too bearish until we're at least in the lower half of the range. And the range is now over 10 points. And when it's that wide, it's hard to be too bearish. And a lot of, half of that came from this week's move. So you say, okay, well, what if we bought a put for protection, but instead of just buying straight up a put, like say buying that March 267 put, which by itself, let's see here, let's go to March 267 put, will cost 237. So I can analyze that trade. You can see, instead of just buying that March, let's sell the February. Because we know between now and February, that's what we have here, you've got a 1 standard deviation of trading down to 264. But we also know where the midway point is of our 4-week range, which is right around this 267, 268 area. So instead of selling at 264, which is kind of in the middle of this bear of the lower half of the chart, let's go for that 267, because then that will, after another couple of weeks, very well could be the lower end of the new 4-week range as we start to move this lower end up higher. That will make it cheaper by selling the February 267 easily within the target. And if you notice now, it's going to cost me $119 for that kind of a hedge. It gives me a lot smaller negative delta if things keep going up, -30 versus a -7. If things do keep going crazy and I have to wait around for a while, I'm going to be spending $3 a day on that long put for a hedge versus not getting any time decay on the calendar. In fact, getting just a smidgen of time decay working for me. So I've gotten rid of the time decay risk. I've lowered any negative exposure. And as you can see, if we do keep going down, I'll get to a maximum gain here around 267 of $180 on $119 cost. And obviously, we don't have to take that whole $119 loss as it starts to come down or it keeps going up. You can see the purple line, what my loss will be, and you can see it will slowly move its way down here to the green line from time decay as if we do keep going higher, negative time decay. But the other benefit to this, see, I want positive vega, and yeah, I'm giving up some of that positive vega, but it's still very positive, and it's the biggest Greek. And so what we're doing here is we're trying to say, okay, I know where my 4-week range can be, right in here. Oops, right here. I know where we can trade if we do pull back, and there's the opportunity for either the midpoint now or eventually the new 4-week low by the time we get to that February expiration. We also know that volatility is bound to make a move higher at some point. According to past precedent, it's bound to make a move higher with how extremely low it is. And if it doesn't, we're not too... we don't have a big risk to the downside. If volatility keeps dropping, we won't lose as much if we did. We would lose if we had bought that put. But we still get some positive vega if we keep going up. And if you notice, watch this maximum gain here. If we do keep going up, you see how it gets bigger and bigger and bigger. And now we're going just a couple percentage points on that volatility index. Gives me a maximum gain of $240 now for $119 cost. So here's a way, something we can do is providing some balance with some negative trades, but not too aggressive. In this case, doing a calendar spread and working out the position size according to what you normally do and how it impacts your overall portfolio's delta with what you're adding. You're not going to be adding a lot of negative. We don't want to add a lot of negative. The posture is strongly bullish, but we have something here, especially with a positive vega, that can help us if volatility does start to bounce without being too risky if we do stay irrationally bullish for however much longer. So in summary, we've had a great start to 2018, one of the best starts, if not the best start to a year that we've ever had in terms of, again, combination of all-time highs and how big the moves have been, putting all that together. Great start to the year. Unexpected, but not impossible, right? Bigger than expected move that possibly because of a few factors we discussed in the video as to why we got it all this week instead of having some around that, because that holiday season kind of taking people out of the game for a while. And then of course that kind of abnormal drop that we had on Friday that we had to recover from on Tuesday. But today's trade idea helps us say, okay, how can we hedge or protect against any kind of near-term volatility or increase in volatility? And that was what we tried to focus on today with our application example. Again, as always, thank you very much for watching. I do appreciate your time on these. Remember to subscribe, like, and comment on the YouTube video down below. Do all three. Also remember to keep engaging on Twitter and on Facebook. Follow me on Twitter at DavidSettle42. Join that Facebook group with the link down at the bottom. Remember, the more you engage with the content there, just likes and shares and comments, the more the algorithms for those sites will keep pushing you my content. So make sure you're not missing anything. Have a great evening, great weekend, everyone. Stay warm for those of you in the Northeast, and for that matter, the Southeast. We'll see you all on Monday.